confident about reaching your long-term goals. Investing is like one day you're soaring high and the next you're plummeting. It's incredibly tempting to jump off the ride when things get bumpy, but bailing out can be a costly mistake. Making drastic changes to your portfolio based on short-term market fluctuations can be like making impulsive decisions. You might end up taking a wrong turn and ending up further off course. Remember the dot-com bubble burst in the early 2000s? Investors who panicked and sold their stocks at rock-bottom prices missed out on the incredible market rebound that followed. Trying to time the market, buying when prices are low and selling when they're high, is a notoriously difficult game to win. Even the most experienced investors struggle with it. Most of the time, you're better off staying the course. So, while it's natural to feel anxious when the market takes a dive, resist the urge to make rash decisions. Stay focused on your long-term goals and let your investment plan be your guiding star. Don't forget that discipline is the foundation upon which successful investing is built. If you're packing for a camping trip, you wouldn't put all your supplies in one backpack, right? If that backpack gets lost or damaged, you're out of luck. Instead, you distribute your gear across multiple bags. That's essentially what diversification is in the world of investing. Diversification means spreading your investments across different asset classes like stocks, bonds, and real estate. Let's take a look at the recent tech stock roller coaster. Many investors heavily invested in tech companies enjoyed significant gains for years. But the market downturn in 2022 showed how risky it can be to put all your eggs in one basket. Those who had diversified portfolios, including stocks, bonds, and other assets, experienced less volatility. Diversification doesn't guarantee profit, but it can help cushion the blow when one investment performs poorly. If one part of your portfolio takes a tumble, other parts can help offset the losses. So, diversification isn't just about spreading your money across different stocks or bonds. It's also about considering factors like geographic location, company size, and industry. A well-diversified portfolio takes into account various economic conditions and market trends. While it's tempting to chase hot investments, a diversified approach can help you stay grounded. So, as you build your investment portfolio, remember this age-old advice. Don't put all your eggs in one basket. When markets are stormy, it's easy to feel like you need to make drastic moves. But sometimes, the best approach is to focus on the fundamentals. Quality investing is about looking beyond short-term fluctuations and searching for companies with solid foundations. When you are buying a house, you wouldn't just buy any old house. You'd look for one with good structural integrity, a desirable location, and potential for appreciation. Investing in stocks is similar. Look for companies with strong business models, healthy financials, and experienced leadership. These are the companies that are more likely to weather economic storms and emerge stronger on the other side. A great example is the recent pandemic. While many companies struggled, those with strong balance sheets and adaptable business models thrived. Companies like Zoom, for instance, saw their stock prices soar as remote work and online meetings became the norm. Investing in such companies would have helped you navigate the market turbulence and potentially reap significant rewards. Remember, the stock market is driven by two main forces: earnings and emotions. While emotions can cause short-term volatility, earnings are the ultimate driver of long-term stock prices. If you're invested in companies with consistent earnings growth, you're less likely to be swayed by the daily ups and downs of the market. Ignore the noise. There's always a lot of chatter about the market, but it's important to focus on what really matters: a company's fundamentals. By sticking to your investment strategy and focusing on quality companies, you can increase your chances of achieving your long-term financial goals. So, the next time the market gets rocky, think of this: quality over quantity. By investing in fundamentally strong companies, you're taking a step towards building a strong portfolio. If you've been investing in the market during the recent bull run, you've likely enjoyed some substantial gains. However, with economic uncertainties and potential market corrections always looming, it's important to protect your profits. This is where hedging comes in. Hedging is like buying insurance for your investments. It's a strategy designed to offset potential losses. While it won't guarantee profits, it can greatly reduce your downside risk. If you're new to hedging, consulting a financial advisor can be invaluable. One popular hedging tool for investors is options trading. But beware, options can be complex and risky if not used correctly. Instead of making a straightforward bet on the market going up or down, buying a call or put option, consider using option spreads. These strategies involve combining the purchase and sale of options to create a defined risk profile. For instance, if you're bullish on the S&P 500 but want to protect your gains, you might consider a bull call spread. This involves buying a call option at a lower strike price and selling a call option at a higher strike price. If the market rises significantly, you'll profit from the lower strike call option, but your gains will be capped by the higher strike call option you sold. If the market drops, your losses are limited to the net premium paid for the options. So, hedging isn't about predicting the future, it's about managing risk. By implementing hedging strategies, you're taking steps to safeguard your hard-earned profits and increase your chances of long-term investment success. Having some cash reserves can provide you with the flexibility to take advantage of buying opportunities during market downturns. However, avoid trying to time the market perfectly all the time. No one has ever done that consistently. Trust us, it's a futile exercise. It sometimes is better to keep cash in hand. Also, stick to your investment plan and avoid making emotional decisions based on market volatility. Regularly review your portfolio and make adjustments based on your long-term financial goals. For example, if you need cash in the next 3 months to meet some expenses, consider selling the stocks which are giving you good returns, especially if you realize they are trading at unrealistic valuations and a big event is in the offing. Even with respect to trading, stay patient and avoid trading. It's okay to take a break. Trying to time the market or chasing quick profits can lead to poor investment decisions. Stay patient, stick to your investment plan, and avoid trading. When markets start to crash, long-term investors often tend to digress from their original plan and try to get into trading for quick profits. Stay away from derivatives if you don't understand them, or use hedges for sure to protect yourself. Market volatility can lead to opportunities to purchase high-quality stocks at discounted prices. Maintain a watch list of stocks you're interested in and be prepared to take action when prices become attractive. It's common for individuals to hesitate when stocks are rising, believing it's too late to buy. However, when stocks experience a significant decline of 30 to 40%, fear often prevents them from acting as well, causing them to miss out on potential gains. Warren Buffett, often called the Oracle of Omaha, is a master at turning market chaos into profit. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." What does that mean? When everyone else is panicking and selling, Buffett often sees it as a chance to buy amazing companies at bargain prices. Recall the time during the COVID-19 pandemic when stocks were available at remarkably low prices. How many investors were willing to buy amid the prevailing uncertainty? Learn from past mistakes and seize opportunities when they arise in the market.